I've been in crypto since 2012. I've made millions, and I've lost millions. I've traded Bitcoin, bought real estate, funded startups, and I even run a hedge fund. But in all that time, through all the risk, reward, and hard-earned lessons, I have never seen an investment tool quite like this. Today, we're talking about stablecoins. Not just what they are, but why they matter, and how they're quietly creating double-digit yield opportunities with far less volatility than stocks, real estate, or even bonds. If you're an income-minded investor, this might be the most important video you watch this year. I'm the Stable Lad. Let's get into it. A quick disclaimer before we move on. This video is for educational and entertainment purposes only. Nothing shared is financial advice. I am not a licensed advisor. Always do your own research and consult a professional before investing. Let's start at square one. A stablecoin is a digital version of the US dollar. You exchange one real dollar for one digital token, and that token is designed to stay worth exactly $1 every single time. It's not trying to double in value like Bitcoin, and it's certainly not a lottery ticket. It's designed to stay put. Think of it as digital cash with two huge upgrades. It's global and it's programmable. Sending a stablecoin is kind of like sending an email. It's instant, it's nearly free, and it's borderless. There are no middlemen, no delays, and no need for your recipient to use the same app or bank, or even be there. There are three main types of stablecoins. Fiat or cash-backed, like USDC or USDT. These are backed by actual US dollars and US treasuries. Crypto-backed stablecoins. Stablecoins like DAI, D-A-I. These are over-collateralized coins that are backed with other crypto assets to ensure stability. Algorithmic stablecoins. These are experimental and have mostly failed. We are not touching these today. If you're frustrated with low yields on saving accounts or tired of watching the S&P swing wildly week after week, stablecoins offer something rare: price stability plus meaningful returns. I regularly earn between 10 and 15% APY by deploying stablecoins into secure, transparent lending protocols, liquidity strategies, and yield platforms. That is income generation without betting on meme coins, without chasing any sort of hype. Compared to the S&P 500's historical 10% earning average, with 15 to 20% annual volatility, stablecoin strategies offer a much smoother ride. Think of it kind of like replacing the bond portion of your portfolio, but with more juice and less noise. So where does the yield actually come from? It's not magic. It is financial plumbing, rebuilt on smarter rails. Here's how. Lending platforms. Think peer-to-peer banking. Platforms like Aave or Compound let you lend your stablecoins to others. Sometimes they're strangers, and sometimes they're traders or institutions who are posting collateral to borrow against it. It's kind of like you're becoming your own version of a bank CD desk, but with full control. They borrow your capital and pay you interest. You can withdraw whenever you want. It's automated, transparent, and governed all by smart contracts and code. Liquidity pools like Uniswap. These are marketplaces where people trade assets directly, but they need liquidity in order to operate. Dollars on both sides of the trade. You can provide that liquidity by depositing your cash into a stablecoin pool. When others trade between the assets in that pool, they pay you a small fee. You get a cut of every single transaction. You're not trading, you're more like a toll booth operator on a highway. Every time someone drives through, you collect a fee. If the road is busy, your income goes up. If the road is less busy, you don't make as much money. Structured products and yield aggregators. These are more like fixed income with options. There are advanced tools like Pendle Finance, which might feel a little bit like Wall Street's structured notes, but for crypto yield. You can basically split up your investment into two pieces. One that receives the principal and one that receives the yield. And then you can do cool things with the yield, like you can sell that future yield, or you can even buy future yield at a discount. It's not really for beginners, but it does open up a ton of creative strategies. Think of it like selling covered calls on your portfolio. You're not risking your principal, but you're monetizing the income stream. All of these strategies exist in the DeFi ecosystem. And here is the beautiful part. The yield is not coming from any sort of hype. It's not coming from some sort of token inflation or marketing gimmicks. It's coming from real demand. People borrowing, trading, investing, and paying fees to do so. Just like how a bank earns money by moving your dollars around, DeFi protocols do the exact same thing, but you cut out the middleman and you keep more of the money in return. You basically become the bank. This is what I mean when I say that DeFi, decentralized finance, has re-engineered the plumbing of the financial markets. No yield comes without risk. Here are the main risks that I manage. Smart contract risk. If the platform has a coding flaw or it gets hacked, you could lose your funds. That's why I use mostly A-grade protocols like Aave and Uniswap. I do deep dives here on this channel on some of these platforms and protocols, how I specifically risk grade them. Peg risk. This is if a stablecoin slips below $1 and it doesn't recover. That's a huge problem. Terra's UST, which was a stablecoin in 2022, collapsed for this exact reason. I tend to stick with regulated and transparent issuers, like USDC for the majority of my portfolio. Custodial risk. With fiat-backed coins, you're trusting the issuers to hold real dollars. Circle, which is the issuer of USDC stablecoin, is a publicly traded company. It's audited by Deloitte and backed by BlackRock's managed treasuries. Regulatory risk. The legal framework is evolving. Thankfully, the Genius Act passed this last June provides real clear rules and protections around stablecoin reserves and transparencies that have never existed before. Stablecoins are no longer fringe. They're infrastructure. There's over $252 billion in circulation as of this recording. It's used by Shopify, Visa, Stripe, and JP Morgan. It's now backed by US treasuries, and regulators are finally on board. If Bitcoin is digital gold, stablecoins are digital plumbing. They're powering the entire system. And here's the kicker. You still have an edge. Institutions are just now catching up, but as an individual investor, you can access the same yield, the same platforms, and the same opportunities before they get crowded and normalized. Stablecoins aren't just hype. They're function, they're income, and they're the future of capital preservation. If you're looking to earn yield without gambling, protect your downside, and build smarter allocations, subscribe to this channel. I'll walk you through it step by step every single week. Let's grow together with less noise, more clarity, and smarter income. I'm the Stable Lad.